Welcome to season one of Margin Talks by Finaloop, where we help explore the flow of money in e-commerce. Today, I have Ben Brachot on the show. Ben is the person I go to when I want to get insight on the flow of funds in CPG and e-commerce, because the firm that he's the co-founder of, Dwight Funding, is often at the center of it. Dwight has been one of the leading providers of credit capital over the last 10 years to emerging brands. So Ben, welcome to the show.
Thanks for having me, Finn. I'm excited to be here.
We're going to start spicy. You've seen a number of e-commerce lenders come and go the past decade. What's helped Dwight have staying power through all the change and volatility in consumer brands?
Let me take you back to 2015 when we launched the business and paint a little bit of a picture of what we saw then. And I think that'll help explain where we are now. Instagram was becoming a sales channel. DTC was exploding. In the asset-based lending world, which is where I came from and spent the 10 years prior, we were focused on funding that lower end of the market, companies that are just starting out, maybe have a need between 1 and 5 million. And we saw the need specifically in food and beverage at the time that later extended into growth stage consumer brands. The beauty of the asset-based lending product is that it's time tested. It's been around since the 60s. Then it started as factoring. It over time matured into asset-based lending. I think some of the products that have come out in the last 10 years or so tried to innovate on the financial product in general. So they were revenue-based loans and payables-based loans and merchant cash advances. And I think they all served a purpose in the moment, but they didn't have that time-tested structure that we have out of asset-based lending. I think the biggest innovation that we saw was we can take ABL, which was a little bit stodgy then, might still be a little bit stodgy now, and modernize it. And so, bring a little bit of that tech from fintech into a product that's really time-tested and a great product for consumer brands to use as they're grown.
Dwight has such a good reputation in the market. You guys have stuck to ABLs when there's been so much activity around some of the other more revenue-based or payables or MCAs. We had a prior guest, Bill D'Alessandro, on the show, and also more publicly on his own socials, talk about kind of anything revenue-based is a sickness on the industry. Do you think is that something that Dwight has considered, moving up the risk curve? And do you agree with him that it is a sickness on the industry?
Look, I think when you're in the widget business, right, your working capital need, you need to fund working capital, right? You need to fund those widgets that you're building. Where companies get into trouble with revenue-based loans is sometimes the revenue will spike. They'll be allowed to draw up on that, and then something will happen. Either a supply chain issue like we saw back with COVID, or marketing broke for a period of time, which happened with iOS 14. And so something else sort of breaks with the business. The revenue maybe takes a small dip, and now they're stuck in this loop where they're over-levered. And so I kind of agree that it's a sickness on the industry. I'm a big proponent of funding your business with the right amount of debt. I think with a lot of these revenue-based loans, unfortunately, companies and founders get themselves into a situation where it might not be the right amount of debt. It might be over-levered, and it's really tough to dig out from that situation.
From some of our maybe early stage listeners that are, again, in the early stages of their CPG or e-commerce career, can you help put a frame around maybe this is what it takes to be bank lendable, basically taking us up the risk curve, and even maybe putting some directional numbers, i.e. bank debt looks like 8 to 10, ABL, revenue, et cetera?
Yeah, I mean, so I tend to look at it all as a progression, right? And maybe we could talk about it that way from just start to exit, right? So say you're running a CPG business in the skincare space, right? And you're just getting ready to launch, and we're talking just about credit now, right? Because I think that launching with a healthy amount of equity is also a good idea. But you don't have sales yet. The brand looks great. The product is formulated and looks great. and you're just about to launch D2C and start talking to buyers at Sephora and Ulta, right? You don't really need credit yet. You haven't proven your sales channel, but you need to put in like your first orders. And I think that funding through friends and family is a really great way to start out. I think using personal credit cards, some of the corporate credit card options that are out there is really a great way to start out, but it caps out, right? Depending on who your friends and family are, that may cap out a little bit higher, but at some point they're going to say no more. And the same thing can be said about like credit cards and local banks, which are another great option, right? And so I think for a company that's doing $0 to $500,000 in sales, or $0 to $1 million in sales, those are all really great options to start out, and the cost is reasonable, right? You're gonna want to pay your friends and family if they're not investing. You're going to want to pay them a fair rate. If you're leaning on your credit card, it's credit card type rates between 1 to 5 million in revenue. So let's say like ecom is humming. You're getting your first POs, but still small, maybe one SKU from some of your like wholesalers. There are still limited options. So it's everything that I just talked about, but you're maybe like pushing the limits of what we just chatted about. But the orders are getting bigger, specifically around like production orders, MOQs with your factories. And so there are good revenue-based options. And I know we just talked a little bit about that, but Shopify Capital is a great product, in my opinion. It's reasonably priced. It's tied directly to your sales. They're short duration loans. They don't scale particularly well, and we'll talk about like what works at scale. But in the earliest days, if you can get a quick $30,000, $50,000, $100,000 at a reasonable rate without jumping through too many hoops, I think that's a pretty good option out there, and one that we often advise companies to go to when they're in their earlier stages. Once a company goes from like 1 to 5 to 10 to 20, and I will like sort of loop all of that in the same, you're going to probably have raised a little bit of equity at that point, a little to a lot, depending on what you're doing and how fast you want to go. And
what year it is.
And what year it is exactly. And you want to have a scalable credit solution at that point. And this is back to what we were talking about, like when you're in the business of making and selling widgets. So now you have an e-commerce business that's humming. You figured out your customer acquisition, who you're speaking to. It's going really well, and you're also entertaining conversations with Sephora. You finally got that launch ready. They're starting to put in POs at much bigger clips, right? $250,000 to $500,000 at a time. You're not going to cover that with a credit card. You shouldn't cover that necessarily with an MCA because the payback period is too tight. And that's where an asset-based line of credit makes a lot of sense. And the way ABLs work, it's a revolving line of credit that you're borrowing against your receivables and your inventory. So you could draw down to make those supplier payments, and then you pay them back out of collections on those accounts. And so that ABL product, again, depending on who it's with, whether it's Dwight or any number of the other like asset-based lending products out there, can really go from like earlier stages all the way through an exit. But let's talk about like what some of the other options are out there, right? I think as companies mature and they're 50 million in revenue plus, consistently profitable, books are tightened up, their outsourced CFO is maybe now insourced team of like 5 accounting people. That is the right time to start looking at like more traditional bank financing, and banks will still structure as an asset based in most cases. Some of them, depending on how like mature a business is, might also structure them as just cash flow loans. So they're revolving lines of credit with covenants, a little bit more to maintain, but cheaper. And so every company has some combination of those things.
And just to put some numbers next to it, is it fair to say that, again, in those earliest stages with the Shopify Capital or something else revenue-based, it's, what, going to call it 25 to 50% plus kind of APRs?
Yeah, look, the APRs are tough to figure out sometimes with some of these like revenue-based loans. But again, let's talk about Shopify for a minute because I do think it's a great product. I think those APRs tend to be in the high teens, maybe low 20s, depending on like what the payback is, and that's fair for where they are on the risk curve. As you start to move down the risk curve, you're probably paying somewhere between high single digits to mid-teens for a good asset-based lender. And as you move to banks, you're somewhere in mid-single digits to low teens in certain cases.
We've got Jacob here from Finaloop for all things e-commerce finance best practices. Jacob, this is another episode where someone has brought up challenges of understanding the true rate behind a revenue-based loan. Does Finaloop have a point of view on how to calculate this?
Yeah, so regarding MCAs and effective APRs or interest rates. So first of all, MCAs are generally not defined as debt instruments, so they're not limited to how much interest they can charge based on various state financing laws. And it's very unclear a lot of times when you read the actual contractual language, even to someone who is an attorney, as to what the actual effective rate is. Because the way it generally works is you'll get a certain factor rate, which will reflect 1.1 or 1.2 or whatever multiple of the capital that you're taking with an additional general fee that you're paying when you onboard, when you take the cash advance. But the actual effective rate, which is what you should be looking at when you're shopping loans and comparing to other alternatives, and even if you don't have other alternatives, you should be aware of what your cost of capital actually is, really depends on your payback schedule and how frequently you're going to be paying the loan back. And if you're capped, if you have remittance caps at a daily or weekly basis, which would influence the effective interest. Without getting too much into details, the general way of thinking about it is the longer of a payback period you have, the lower your effective interest rate is going to be. And the more condensed your payback period is, the higher your effective interest rate is going to be, right? Because a cash advance or all these revenue-based loans are not like ordinary loans that if you pay back after day one, you're going to have maybe some kind of fee for repaying the loan early, plus some very minimal interest that you pay the entire amount back no matter what, right? So the example that I've discussed in the past is if you have a $100,000 cash advance, other than the initial upfront fee, which you may be paying, if you have a 1.2 factor, it means you have to pay back $120,000. If you pay that amount back at a year from now, then yes, it would really be somewhere in the range of a 20% effective interest rate. But because the payments are based on your sales, and a lot of them will be earlier, even if it would be at a half a year period, it wouldn't really be 40% without taking compounded interest into account, but it'd be much, much, much higher because your paybacks are generally based on your sales, and assuming you have a decent amount of sales earlier on, it's much more weighted towards the beginning of the period. So your effective interest rates, I mean, even if the factor rate is 1.2 or 1.1 or 1.15, your effective rates a lot of times will end up being in the 50, 60, sometimes even 100% range. Again, the greater your sales initially, the higher the effective interest. Now, it doesn't necessarily mean they're not good instruments. As Ben said, a lot of times these are very good instruments, and it's just a different place on the curve of the risk. And because they're higher risk loans for earlier stage companies, the interest and effective interest rate is going to be higher. But it's worth being aware of these interest rates and trying to do some kind of basic calculation when you take it out, projecting your sales and the percentage out of them, just to see and be aware of what your cost of capital actually is on this MCA.
Sticking with that maybe $1 to $20 million cohort, the role of equity. Let's skip past the kind of friends and family round. Does Dwight like to see a lot of equity in deals? Is it a prerequisite? Yeah, how do you think about that?
I always think about how you raise capital in general as telling the story of your business, right? And so we're a little bit agnostic. We don't have hard and fast rules that say it has to be these 5 funds that invest. We've been really fortunate to work with companies like Hero Cosmetics that bootstrapped the first 8 or 9 years of their business, and built a phenomenal foundation doing that. And we've also worked
You take
alongside.
equity warrants, right?
I wish we did. Uh, we've also been fortunate to work with like great early stage investors like Willow that will come in basically pre-launch on an idea, find the right management team, the right brand, and the right product, and they'll invest. So back to your question, I don't think there's like a right or wrong answer out there, and I don't think that there's necessarily a hard and fast rule that we apply. That being said, we want to make sure that a company that we're working with is appropriately capitalized, meaning that if they're launching into retail, they have enough capital to support the marketing, the team, the branding that's going to be involved. And if they're losing money, which a lot of early stage brands are losing money, that they have enough of a runway to give themselves a buffer, right? We don't want to be that last dollar in, and nobody should want their lender to be that last dollar in.
Clearly, you're very thoughtful about your business. You've recently announced that you've deployed $250 million this year. Is this the biggest year ever for Dwight? And what's driving all this volume?
Yeah, look, we don't put out a lot of press releases. And so while this year was great, it is in line with the last couple of years that we've had. There's nothing major that's driving a lot of the growth that we're seeing out there, other than the fact that we've now been doing this for 10 years. We've invested an incredible amount of time and energy into nurturing the CPG community and the DTC community at large. And we've been consistent. Our product has been consistent. Our approach has been consistent for, the companies that we've worked with. They know that we sort of operate the same way day in and day out. And I think that there is stability in that becomes attractive, especially when there's, fluctuations in the market. And there have been, the last couple of years, there have been lenders that have come and gone. There's like an element of this flavor of the month, the new debt product of the month. I know you and I have spoken about here and there. For a lot of the brands that we work with, we've actually known them for years. So on average, like we'll know a founder or a brand for a couple of years before we even start working with them, where we're like advising them, helping them, making introductions for them, and when it's the right fit for us or for them, we'll engage, and hopefully we can sort of grow with them as the business matures.
Speaking of kind of nurturing the community and that real kind of focus in long-term relationships, you were recently written up in an Inc. profile with Dagne Dover's founder, Deepa Gandhi. I don't think I've ever seen a lender and a brand founder stand side by side in a profile shoot. Maybe share that story.
Yeah, that was such a funny day. We were in Dagny's Soho store before they opened. I've known Deepa now for close to 10 years. We're chatting about life, chatting about business, and the photographer for Inc. kept telling us to both be serious. And so you've got me looking mad. Deepa couldn't hold back a smile. It was a funny day, but this is actually the first. They do this issue every year. This is the first time that they included lenders. And I think that speaks a little bit to where we are in the cycle. I think that speaks a little bit to the relationship that lenders like us have been able to develop with some of these companies. We've been working with Dagne Dover for close to 10 years now. And it's been a partnership, right? They were a very, very different business than when we started with them than with where they are today. We've been supportive of them and vice versa. So we really do look at it as a partnership. In that article, we talk about a couple of like situations where we do things or we've done things that not every lender would. I remember being on a late night call with one of Deepa's suppliers. I think at the time they were looking for like a letter of credit. We were trying to explain to them the letters of credit are, out of favor with a lot of factories these days. But explaining our product, the line of like our line of credit, how it works, and giving them comfort that Dagne has access to that. And then through the years, like we've just supported them where they need to, and that's, I think, really important to look for in like any type of lending relationship, is make sure that who you're working with really gets your business. The touch bases are happening consistently, that it's not only when there's like an emergency, because oftentimes when people are reacting in an emergency, that that it's not the right reaction. But if you can build that relationship with a really solid foundation, when you call, when there's good news, it's great. When you call and there's bad news, you figure it out, and nobody's like overreacting.
A lot of listeners that come to Margin Talks are looking for financial best practices. You've seen probably as many brand financial statements as almost anyone. What are some common missteps that brands are still getting into trouble in 2024?
Maybe this is the most important thing we talk about today.
Yeah, let's do it.
Look, I think first things first, accounting is not a cost center for your business. You need to invest in that early, and you need to continue to invest in it as your business scales. So what does that mean for like an early stage company? It doesn't necessarily mean go hire a six-figure CFO. You probably don't need that, but there are really good outsourced CFO groups out there, and people should engage them early. And again, not look at them as a cost center, because building financial statements that are accurate is your only health check for what's happening with the business. Like, yes, you could look at. We've seen plenty of companies that are growing rapidly, revenues at an all-time high, profitabilities even at a happening at a good clip, but they run out of cash, and that's just a function of not having their eye necessarily on the ball. So I would say number one is invest in accounting at every stage. There are probably inflection points like we talked about: 0 to $1 million, $1 million to 10. 10 to 20, and 20 plus, and they all sort of require leveling up your accounting function. The second is, something that we look at a lot, and some companies, especially DTC companies that are moving more towards omni-channel, which is everyone, don't always have a focus on it, which is AR collections. So, for a lot of DTC businesses, they realize that wholesale is an unlock. All of a sudden you can, start to move product in serious quantity, and they sell the product and they ship the product, and oftentimes they forget to collect. It's a different muscle to exercise, not one that the company's done before. And so we've seen over and over, really great companies just have AR that, may be a little bit mismanaged. And they're pretty basic things that you can do. Like figuring out who the AP department is, and making sure that they got the invoice, and then checking in right before the invoice is due. Right, little things like that are seem basic, but are highly effective in making sure that you get cash into the business. And then I guess the more advanced tactics that I would point to. Or do a monthly review of the financials with your accountant, your CFO. Start to build in the practice of doing a 13-week cash flow. And a lot of folks don't know what that is, but we actually started pushing it to a lot of our clients. We put a 13-week cash flow template on our website, which, we could drop the link to that as well, because it's more than just a document. It's actually like a weekly flow that you go through with your team to understand like what your cash outflows are, what your cash inflows are, and make sure that you're looking 13 weeks out and identifying any issues that might arise. so that you could talk to your investors, talk to your lenders about that.
Jacob, Ben here talks about a 13-week cash flow model. What goes into a 13-week?
Yeah, so regarding 13-week cash flow forecasting or cash flow forecasting in general, it's a really, really important to do, I think, in any business, no matter what your line of business is, and specifically when you're in the very seasonal e-commerce business and cash flow is really tough and you have inventory on the one hand and getting cash on the other and perhaps needing financing, etc. It's really important to forecast out and from today going forward and taking all of your projected future cash flows into account. So I think a good place to start generally is actually your cash flow statement and working out of there, seeing within the past period what is more of like a one-timer that won't necessarily repeat itself. A big payment, a big loan that you withdrew or paid back, a very big inventory payment or payment from a wholesaler, which you may not necessarily see in this period. I'm going to kind of see what are expenses that would repeat themselves on a regular basis, like payroll, a lot of your fixed expenses, and kind of take it from there and then plug in based on your sales projections, your projected sales, taking into account your discounts, right? Because if you are discounting, then you're not going to be seeing all that cash coming in. And another big one, especially for selling to wholesale, and for everyone on the AP side, is putting in your AP and your ARs, taking into account the payment terms and the actual payments, meaning when you actually anticipate to pay, which may be earlier or maybe shouldn't be, but in practice might be later. And when you're planning on actually collecting your ARs and all of your receivables, because obviously that will have a huge impact on your projected cash flow. And just like you kind of have to adjust for previous one-timers, which might not necessarily reflect what's going on in the next 13 weeks, you should keep in mind additional one-timers that will actually impact your next 13-week cash flow. Do you have another inventory purchase, another big-time legal expense, or are you closing around and going to see a lot of cash coming in? Whatever it might be, taking one-time events that will likely are anticipated to occur in the next period is also a good idea. And just in general regarding your financing, if you anticipate paying interest or principal repayments in the next period, that obviously should be taken into account, especially if you have a revenue-based loan. That can be when you're making your projections about what your sales should look like, then obviously that would be a percentage out of those sales. And kind of like at the end of each week, you kind of have your ending balance, which is after all of what we discussed kind of flows into your bottom line, and the next week would start from that same number. And the more granular you get, the better. Obviously, it's never going to be perfect, but if you're not forecasting, you're definitely not going to be even close to there. And it's really important to see where you're going to have not enough cash, and so you can kind of get ready for financing, trying to extend those AP and make AR shorter, maybe just to kind of reach the next period. So having that picture in your mind and being exactly aware as best as you can of what your cash flow looks like is really crucial to managing your business well.
Do you get nervous if the outsourced either CFO or bookkeeping group is generalist as opposed to consumer products focused, or you think that that's okay?
I think there are good groups and bad groups, like in any industry. I don't think that specialization necessarily on its own is the consideration. I think that you need to have like a good working relationship with somebody who understands your space, understands the nuance of your space. Like, would I be a CPG company? Like, would I recommend that a CPG company go out to a generalist firm that has never dealt with chargebacks and reconciliation of of invoices? Probably not. But that doesn't limit the field only to, CPG specialists.
I think also really great fractional CFOs can not only kind of have the literacy that you're talking about, but also are helpful in coaching brands around industry margins and benchmarks, and say, hey, like your marketing spend as a percentage of net revs is not only high relative to last year, but also high relative to all of our clients, or hey, your cost of delivery is probably 3 to 5 points higher than anyone else in this category that we have. which is particularly useful if they don't have that kind of insight from their investors, or they may not have investors or lenders, etc. So sometimes when we are telling a brand that like, hey, do you know that like your chart of accounts is a little bit wonky, and if you actually include your fully loaded cost of delivery, it's like 28% of net revs and like not really sustainable. And they're like, oh, this is just kind of what our accountant gave to us on day one of the business.
Isn't it so funny how, I think you paid me the compliment that I see a lot of financials, but you probably see just as many, Finn. Like, if you look at the chart of accounts, you know pretty quickly if somebody that knows what they're doing put them together or not. Occasionally, we'll get intro to a company and it's early, and their accountant put together their chart of accounts, and we can like raise that flag really quickly and say, hey, go find a specialist. Go find somebody who knows what they're doing.
I was thinking about this the other day, and I was kind of shocked that next March will be 5 years since the beginning of COVID. For most brand owners, and it's felt like a bit of a blur, and that we've kind of been in a period of extended stagnation. What do you hope for e-commerce brands and CPG brands in the next 5 years? Where do you hope that will be?
I'm feeling really bullish on consumer. I think that consumers are excited. I think the consumers are spending. There's still discretionary income out there. I think that a lot of the noise of the last 5 to 10 years has sort of washed away. Yes, the barriers to entry might be low, but folks have sort of learned that you really do need to be differentiated. You need to be selling a quality product. You need to be able to like speak to a consumer about what they want. And so, we're 5 years post-COVID, but the brands that are left over, the brands that have sort of survived the supply chain issues, the tariffs, iOS 14, they're all stronger for it, right? And so I'm really bullish on the market that we're in. I think the other consideration is that the founders that are still left in this space, they get it now. Equity is tougher to come by. It's more competitive. They're running leaner organizations. They're not spending frivolously. And so I think for our industry as a whole, I think that there is a lot of upside in it. But specifically for like the brands and the founders in our industry, I think that there are really a lot of opportunities to win.
Interesting that you mentioned that founders are so much more sophisticated after the muscle they needed to build over the last 5 years. Our mutual friend Sam Kaplan, who I think maybe introduced us first 10 years ago, I did a recording with him recently, and he kind of said something very similar, that founders have just gotten so much more sophisticated since when he first started investing at Birch 10 years ago, that today versus then, they know what their gross margin needs to be, what their contribution margin needs to be. They know how difficult it is to raise equity, that it's not just kind of guaranteed based on trailing 6-month growth. And we would hope that all of that points to kind of good signals in the next 5 years. This wouldn't be a consumer products podcast without asking, and whether it's in portfolio or not, what's in your cart these days? What purchases have you been pondering?
All right. So, coming off of the conversation we just had about Dagne Dover, I feel bad maybe plugging them, but somebody gave me as a gift yesterday their new garment bag, the one that folds into a duffel, and I'm in love with it. It's
amazing.
That's amazing. But, moving on to other categories, one of the downsides maybe of being in the consumer space is that I'm like the ultimate consumer. On winter gear, I'm really liking this brand called Ether. They are an LA based company. I discovered them last year when I was going out snowboarding, picked up a couple of their like outdoor things, and some more base layers right now. And I'm on this like health kick at the moment. And so I've been leaning into all of the stacks that Momentous is selling. So they sort of merchandise their products by different stacks depending on what you're looking to do. And I guess I'm looking to do all of it.
Speaking of health, I remember I drank a Celsius at your office and you said, oh, don't do that. You're going to die early. Are you still light on the energy drinks?
I think there's good energy drinks and bad energy drinks. I don't know if I said that you're going to die early, but I did once drink a Celsius at 4 p.m. and that's a mistake. You will be up all night. But I think that there's some really interesting energy drinks out there that are using better for you ingredients, and maybe take the jitters off a little bit as well.
Ben, thanks so much. Always so fun to catch up. Thanks for sharing all the wisdom. For the listeners that want to double click, where do they find you? What's the best place to learn more about Dwight?
Yeah, we have an incredible team that I didn't talk enough about today, but a lot of folks in the market already know them. I think best place to find us is dwightfunding.com. We're also, in most of the rooms that you're in out there. So I'm sure we'll bump into each other.
Awesome. Ben, thanks again, and can't wait till next time.
Yeah, thank you. Thanks for having me on.
Thanks for listening to Margin Talks by Finaloop. Don't forget to like and subscribe on the channel you're listening to. If you have any questions or feedback, feel free to email me, fan@thehedgehogcompany.com. And if you'd like to see what Finaloop can do for your e-commerce business, please visit finaloop.com. We'll see you on the next one.